Hello and welcome. Don't get caught with your pants down. Protect your yield. If you have $25,000 or more in Ally's high yield savings account, protect it with what I like to call the Ally two-step emergency fund. A no-brainer for those who just want to keep their emergency funds in 100% liquid cash. Okay, recently there's been talk of the Federal Reserve lowering its target fund rate to help stimulate the economy. With that being said, while there is talk of lowering interest rates, we cannot predict what the future will hold, and that is also true with interest rates. Okay? They will either stay the same, go up, or go down. However, what we do know is this: the Fed fund rate target is closely tied to the interest rate paid on savings accounts and CDs. This is a fact, and it will impact the yield on your emergency fund if it is in 100% cash. The purpose of this video is to show you a method to possibly reduce your interest rate risk in a 100% cash emergency fund. In the comment section below, I will also include an article by Andy Radcliffe of Wealthfront on how the Fed fund rate impacts savings and CD yields and how typical banks and financial institutions respond to these changes in these federal fund rates. Now, one thing is for certain: a lot, and I mean a lot, of people love Ally Bank and their high yield savings account. It's a great bank, excellent customer service, and they offer very competitive rates. Ally has a strong, committed, and loyal following of customers, including me. A lot of people who use Ally's high yield savings account use it as their emergency fund. I do. But it's not my entire emergency fund. You see, I get a little geeky, and I use it as part of a wider, broader, short-term savings and investing plan that includes tiered emergency funds, tiered sinking funds, fixed income ladders, and taxable brokerage account. But again, I enjoy the complexity. So my level of complexity is not for everyone. When it comes to emergency funds, there is a level of complexity that is right for you. What is right for you is personal, based on your financial needs, your risk tolerance, and your knowledge of finance. Okay, so let's look at the levels of complexity and see where this two-step emergency fund fits in. The first level is going to be your regular brick and mortar savings account, okay, and possibly the same one you have your checking account with. Generally, it's going to pay a little bit less interest, but it's right there. You don't need online access. You don't need to do anything funky or fancy with it. Okay, so that's probably the simplest. The next level of complexity is a online high yield savings account. Oftentimes, you'll see this abbreviated as HYSA, as you see right there. Okay, they're going to generally offer better savings rates. Okay, because they do not have that brick and mortar component. Ally Bank is a good example of that. The next one is what we're going to be talking about today, and that is complexity level 3, and what I like to call the two-step emergency fund. And basically, in a nutshell, what this is a high-yield savings account coupled with a no-penalty CD strategy that you're going to use. Okay. The next level of complexity is online high-yield savings account and using CD and treasury bill ladders. Okay, so this is adding the level of work that's involved, building the CD ladders and constructing it. So there's a pretty significant amount of work in building these online high yield savings accounts and CD ladders, treasury bill ladders, to work out a little bit better return with that. So that's an added level of complexity. I think most people there are going to be at the complexity of level 2 right here, and level 3. And if you get a little geeky, you might be going into 4 and 5. Okay. The fifth level of complexity is a tiered emergency fund. And again, this is a wider, broader short-term saving investment plan that's going to incorporate a lot of short-term fixed products, including brokerage accounts, and having it tied closely to sinking funds and planned expenses over the next couple of years. Okay, so that's much more involved, and that may not be right for everybody. That complexity may be too high. I like it, but I get geeky like that. And then at some point, when you have between 5 and 20 your emergency funds in a taxable account, you may not need an emergency fund anymore. Okay, so if your ideal emergency fund is $30,000 and you have $300,000 in a taxable brokerage account, you may not need that emergency fund anymore. And there's some options and benefits to doing that. In the comment section below, I will post a link to another article by Randy Ratcliffe on when you can get rid of your emergency funds. I highly recommend you look at that article as well. Now, looking at these funds, when you're looking at particularly the first two, with 100% of your emergency funds in savings, you are vulnerable. You have no protection for declining interest rates or the opportunity to optimize your interest rate yields to offset some inflation. You have to remember, inflation and taxation will eat at your returns. It's important for you to understand this, as this is a risk factor that is too often ignored in these 100% all-cash emergency funds. You'll often hear a lot of folks talk about, well, don't worry about your return on your emergency fund. You know, it's more of insurance. But again, the inflation and taxation will eat away at your returns and eat away at your emergency fund, where in 10 years, if you have that $30,000, it's going to be worth considerably a lot less buying power in 10, 15 years because it's not been able to compete with inflation and taxes, you know. But, you know, you have to judge your risk tolerance. So maybe that's where you need to be. You can't handle any higher complexity or risk than that, and that's fine. So maybe step 3 will give you some more options without too much complexity. All right. Now, I'm going to give you an analogy, probably from your mother. Okay, think of it like this when we're comparing and talking about emergency funds. What are you doing? Go put a belt on. Do you want to get caught with your pants down? We've all heard it. Well, I've heard it because, you know, it happened to me. Because when I was a kid, I was a little husky. And, you know, if I didn't have a belt on, you know, chances are if I was running down the street, you know, my pants could go down. You know what I'm saying? So same thing with your emergency savings, okay? If having a high-yield savings account only for your emergency fund is like having your pants on without a belt, okay? So to protect your pants, which is your savings, from falling down during a period of deflation or declining interest rates, you need a belt, okay? The belt is a CD, okay? Particularly here we are looking at a no-penalty CD, so you can keep your money liquid if you need it, okay? And Ally's no-penalty CD will protect your pants from falling off for 11 months. Okay, that's the term of the CD, by keeping the yield constant during a period of deflation or declining interest rates, or what you would likely see in a recession. Ally's no-penalty CD will also protect your pants during rising interest rates by allowing you to withdraw penalty-free and lock in a higher rate. Think of it this way. You're gaining weight and you need a bigger belt, okay? So the Ally no-penalty CD gives you some downside protection with upside flexibility that your regular high-yield savings account or regular brick-and-mortar savings account is not going to give you, with relative ease. So you can open one of these accounts and have it renew, but you do need to periodically check to see where the interest rates are to see if you need to cash it out for a higher rate, okay? And we'll talk about how you're going to construct that. Now, the Ally two-step emergency fund, how you're going to do it is this. You're going to have 1 month of expenses in Ally's high-yield savings account, okay? This will hopefully cover any expenses that you cannot cover with cash flow and sinking funds, okay? So these are expenses that are emergencies and unplanned for. Step 2, now, of course, Ally right now is offering 2.2%, okay? Step 2 is going to be 2 to 6 months of expenses in Ally's no penalty CD. Okay, and this is where ideally you'd want to have $25,000 so you can capture the higher yield, and this is for 11 months. And if you can get that higher yield, it's going to be 10 basis points higher than the online savings account. And you're thinking, oh, it's only 10 basis points, so what? Now, in a declining rate, this here can drop overnight to 1.1, and then you're gonna think, boy, I wish I would have locked in that CD for 11 months. Okay, so the only thing you have to be aware of when you do open the no penalty CD, there is a 6-day hold on the account. Okay, so you won't be able to access within 6 days of opening. After that, you could close it out immediately if you needed to. Okay, or if interest rates went up. So there is that 6-day windows, but it shouldn't be a big factor because again, you have step one. You're going to have 1 month of expenses in your online savings account. Okay, and 6 days. A lot of times, if you're moving in between different accounts from your regular account, if it's not with Ally, it takes a couple days for that money to transfer over. So 6 days is like twice as long as what it usually takes for a regular transfer to get over. So it shouldn't be that big of a deal for you. Okay. Now, again, competitive rates. The interest is compounded daily. They have a 10-day guarantee. Okay, your deposits FDIC insured to the maximum allowed by law, and they do have the option you can allow it for trust and stuff like that. But a good option out there if you want to maintain cash in a savings account or have the flexibility and protection of a CD without hitting the penalties on these rates. And the penalties on their high yield rates aren't bad, but this gives you the flexibility for that 11-month. I don't want to go too much involved because then if you're going to be doing that, you might want to look at constructing a CD ladder, which is another level of complexity. Okay. Now, just for those who may be new to emergency funds, a couple of words of advice. For emergency funds, you want to generally try to fund your expenses with cash flow, sinking funds before you tap into emergency funds. And you really want to fine-tune your budget and reduce unnecessary expenses. And you should be debt-free except for your house. Use sinking funds for planned larger expenses. Generally live below your means. Save a high percentage of your income. And cash flow is king. When you can cash flow a lot of these unexpected expenses, it will help you with the budget. And again, the more you refine your budget and reduce your expenses, you're going to notice you're having less unexpected expenses. Okay? And again, generally at a minimum, 3 to 6 months of living expenses for your emergency fund. Okay, so thank you for watching this video, and up in the corner, I'll have a link to Steve Urkel on his paycheck savings songs, which I enjoy, and if you're into financial independence or anything like that, you'll get a chuckle out of it. So again, I thank you very much for your time and for watching this video.